Well, there's very little fail-safe built into electronic trading itself, but the New York Stock Exchange does have a circuit breaker rule. That's only triggered by a 10% decline, and a 10% decline is more than a 1,000-point loss. Thus, we don't have any kind of market-wide protection against the kind of problems that really are a cascade-like effect, as we saw yesterday. We have market-wide protection, and I think it should be updated. I think this sort of problem, which is essentially a replay of the 1987 market crash, is fundamentally caused by computers that are programmed to sell after a specific decline, either in the market generally or in a specific stock. And that puts us all at the mercy of the trader with the most short hair trigger. Because if someone has a computer designed to sell off his holdings in a stock after a 3% decline, his sales can cause someone with a 4% trigger to sell off. That in turn causes the 5% trigger to be activated, and on we go till we get the kind of decline we had yesterday. I think the kind of answer to something like this, because it is the product of computers in effect acting on each other, would be to have a very short intervention, possibly a 10-minute trading halt after a 5% decline, at which point human judgment can re-enter the scene. What we saw yesterday was eventually human judgment did re-enter, but only after a 1,000-point drop, and the system itself would only require a trading halt if there was a 10% market-wide decline. I think that's a little too much, and it leaves investors a little too exposed to these really sudden dives.